We haven't made any changes in that call. It's based on our impression that when we look at where the center of the committee is, where the leadership is, that their baseline has been a December hike as of the June meeting and some of the speeches in early July. And we haven't really seen anything either in the data or in the communication that has changed that. So we haven't made any change because there's been, for us, no reason to change.
I do think that this is one more sort of steady step along the way towards the Fed likely hiking in September. I think it's more likely than not. I don't think it's quite a done deal. We've got 5 weeks of data, and we've learned anything in the last several years. A lot can happen in 5 weeks. I think the fact that wages are still a little soft and the inflation outlook is a little bit concerning for some Fed officials is probably the only thing left to be checked off from their view. But yeah, I think that we're probably in line for a September rate hike.
The bar has been reset in this retail space. I think Macy's is the one to own here for the short term, but long term, I caution you. I think they're going to have some real struggles. Look, it's a great brand. I get it, but I think their online business is going to compete head to head with Amazon. Amazon's going to displace them by 2017. I think right now is the time to buy it for a trade. I think the stock's been beaten up. There's no expectations they're going to make numbers. I think you get a trade to the upside, but I'd caution you long term. I'd stay away from the stock.
Alibaba, if you look at earnings, if you look at it on a chart, it's been beating on earnings, but it has caved about 30% going back to November of 2014. So beating on earnings doesn't mean anyone for this. It doesn't mean anything for this stock, and it's been a mess on the charts.
It's teetering on approaching the 200-day moving average, so it is really coming very close to that very dangerous technical point of breakdown. And pretty much triggering what's called the death cross, where 50 and the 200 kind of drop below it. But, I think the biotechs themselves are just a fascinating sector. It's the only sector in the S&P that's completely binary. It's either a billion-dollar product or a big bagel, and therefore it has the hugest volatility. There's a reason why some of the best hedge funds in the world made most of their money in the biotechs, because those are things that really just simply take off. But when they correct very, very hard. And I don't think this correction is over by any means a stretch of imagination. I think we may see further choppiness in the sector before it comes back to further highs.